Today's episode is brought to you by Public.com, an investing platform which you'll be hearing more about later on in the show. But for now, let's get into today's interview. Welcome to Forward Guidance. It is Thursday, March 23rd. We are recording one day after Fed Chair Jay Powell raised interest rates by 25 basis points, signaled it may be the last one to come. So much to talk about. The banking system, the turmoil continues, but is it over? Who knows? And I am joined by an all-star team, Joseph Wang, Chief Investment Officer of Monetary Macro, author at FedGuide.com, and Randy Woodward, Managing Director at Raymond James Financial. Gentlemen, welcome.
Thanks for having us.
Thanks for having us. And you guys, Randy is a super expert on regional banks. He's been doing this for decades, and we know there's a lot of excitement in regional banks, so you definitely want to tune in to listen to this.
I've been doing this since 1988, and I just want to share my experience. That's all.
First, let's just start off. What were your broad thoughts of the Federal Reserve's meeting yesterday in terms of the dot plot, the statement, and the press conference? Joseph, let's start with you then, Randy.
So I think two things stood out to me. The first was that Chair Powell basically was telling everyone that their deposits are guaranteed. Now, for those of you who aren't familiar with how the US works, you need an act of Congress to do that. That being said, once a bank goes into receivership and is taken over by the FDIC, the branches of the executive government have some special powers. For example, when Silicon Valley Bank was taken over by the FDIC, the government guaranteed all their deposits. Now, what Chair Powell is trying to say is that, so he can't literally guarantee everyone's deposits, but he's strongly hinting that if your bank goes under, your deposits are going to be safe. So in effect, he's trying to stop the banking panic. The second thing that I thought was really interesting was that, well, he's making a rough calculation between between rate hikes and how the regional bank panic is impacting the transmission of monetary policy. So Chair Powell is trying to slow the economy down by raising rates. And what you think is that when you raise interest rates, usually people face higher borrowing costs, and so they go and borrow less and spend less. Chair Powell was thinking that this banking panic might put a dampen on the willingness of banks to lend, so the supply of credit, and that might be equivalent to, let's say, maybe 1 or 2 rate hikes. It's totally vague, not sure, but it has some effect. So he's thinking that he might not need to do many more, if any, more rate hikes, depending on how this regional bank thing shakes out. So that's what I thought was super interesting. What about you guys?
So the Federal Reserve raised 25 basis points. The top range for the Fed funds is now 5%, and the forward rates what the market is pricing is a 55% chance that there's no hike in May. So basically the hiking cycle is over. Joseph, you and I have been very cautious to use the P word, the pivot word. I think the pivot we're going to be using that word a lot more. Also, your view that Powell was winking and nodding about guaranteeing bank deposits, very interesting. My reading is he just saying that the banking system was sound, but that's a very interesting reading. And then, of course, one of the most important quotes, Randy, I want to get your thoughts on, was with Joseph just referenced, was Powell saying, yeah, the credit contraction that we're likely expecting, that is equivalent to a rate hike, or it could be even more. That is very stunning. Randy, what were your thoughts?
My very simple opinion is that when you raise rates 400, 450, 500, like that, it's, the effects there. I don't know I don't see any reason to take it any higher. The only reason I can fathom is that they wanted a little more room because they know cuts are coming eventually, but they don't want to go back to zero bound. They want some room. If I had to guess, they would love to just land at 2%, landing it on a super carrier and then just stay there is where they'd really like to be. I don't think they want to go to zero bound again, because we are seeing the ramifications of that. As I, said over and over again in 20 and 21, that this zero bound and this Fed buying mortgages and crushing spreads is going to have future ramifications. We don't usually really understand. I didn't know what the ramifications were going to be back then. One is banks now are sitting on incredible amounts of unrealized losses. Doesn't mean it's a bad thing. It just means that it's an exposure that we did not see because inflation wasn't an issue yet, and we didn't know the Fed was going to hike rates 500 basis points. That's my opinion, and I think he just needs a little more time to hang out here so he can hopefully get some evidence that inflation is finally being tamed, and then we're going to see a pause, and we'll go from there.
That, Randy, is a key point of difference between you and Joseph. You agree, my reading is, with Chris Whalen, who said the Federal Reserve is to blame for the fall of Silicon Valley Bank because of quantitative easing. They caused all this money to flow in. It bought securities that then declined in value. Joseph, you are on the other side of the Silicon Valley Bank had horrible interest rate risk management, and you should let bad actors fail. And if any other banks have also bad interest rate management, maybe they should fail. You are against bailouts. You say it is on the responsibility of the banking system. These are two very different views that I think are very important to explore. Joseph, could you outline your view about why you disagree, why you think the Federal Reserve is not to blame for the banking turmoil?
Well, I think the Fed hikes rates and the Fed cuts rates, right? That's what the Fed does. And the job of banks is to manage around that. We have over 4,000 banks, and we have, I think, 3,000 or 4,000 credit unions. And when you look across the space, it seems like those who busted are those who are, one, exposed to very fragile industries, like exposed to industries that were very interest rate sensitive and were not doing very well, like tech and VC and crypto. So Signature Bank, Silicon Valley Bank, First Republic, these are all banks that are known for their connection with the tech sector. So when interest rates rose, those tech sectors did poorly, and the banks are connected and did poorly as well. I don't think that surprises anyone. And as far as I know, when I'm looking across the banks, it seems like everyone else is just fine. So that suggests to me that there's maybe something idiosyncratic going on, something about how the banks manage their exposure to different industries. Silicon Valley Bank in particular is very badly managed in the sense that not just their asset side of the liability, and Randy makes really good points that when you have a lot of securities and rates go higher, you have a lot of unrealized losses. But there's also the liability aspect as well. So if you're a bank, you want to make sure that people don't all take their money out at the same time. And there are so many ways of doing this. A common way is to have, let's say, CDs where the depositor can't take their money back until 3 months, 6 months, and so forth. Another very common way is to just have a diversified depositor base. You have a lot of retail depositors protected by $250,000 in FDIC insurance, so they have no reason to run. Or you can have depositors across different industries so that if you have one industry that takes a big hit, well, you don't go bust. But Silicon Valley Bank, basically highly concentrated in tech and over 90% uninsured. So it was a bank for people who would be inclined to withdraw their deposits at the first hint of trouble. In contrast, when you look across the US, usually banks have about 50% of their deposits uninsured. So Silicon Valley Bank decided to make their depositor base manage the deposits in a way that their depositor base was very vulnerable to runs. And I think that's on them. Now, the Fed certainly did not help. And maybe if the Fed didn't hike 400 basis points, Silicon Valley Bank would still be here.
Real quick, like maybe if the BTFP was invented on a Friday rather than a Monday, Silicon might still be here.
No, I'm sure. I'm sure they probably would be here. I mean,
Silicon Valley, very Lehman-esque to me.
Yeah, it's like they were kind of late a day, right? And so think about all the people in Silicon Valley Bank. They're like, no,
yeah,
if only you came about like a few days earlier. But
yeah,
but I think a bank has responsibility as well. So you got to manage around that.
Right. Okay. And BTFP is the bank term funding programs where banks can pledge government securities as collateral to secure loans from the Federal Reserve for a duration of up to 1 year, and they can post it at par value. They can post a security that would trade at $80, let's just say, and get a $100 loan. So, in some ways, very, very generous to the banking system. Joseph, you very articulately laid out the case. The Federal Reserve is not to blame. Silicon Valley Bank, they had bad risk management. Randy, what's wrong with that case? Silicon Valley Bank, they had $100 billion of deposits inflows, and they put it in these risky agency mortgage-backed securities that would decline in value rapidly if interest rates spiked. They took these risks. What is your response to that argument?
Well, first off, that's not a risk. It's no financial, no community bank could know that what they were going to do. And even if they knew, there's nothing you can do about it on the whole. You can mitigate, but on the whole, you've got to buy bonds that give you a spread if you're putting it in the investment portfolio. And by the way, it's the same on the loan portfolio. So really, let's just call it investing. You got to make a spread to whatever your funding costs are. So when I see a lot of that out there that, oh, well, they made risky loans. And I think that's what really got me going really on this whole situation is I see very intelligent people out there. Let's call them out. Richard Fisher, this past couple days ago or over the weekend said, these banks have made bad investments. And that's just simply not the case. Let me try to explain. So, well, first off, what Joseph just said is 7 hours worth of content. So there's so much to talk about here. Obviously, we're not going to get it all in this, but all his topics and his thoughts are absolutely fantastic. A 5-year treasury has a duration of about 4.5 years. Okay, duration is just basically a measure of interest rate sensitivity, which is what we're seeing in markets right now. Is that these banks invested in bonds that have certain durations, and if rates go up, those bonds are going to feel a certain amount of loss, unrealized loss, by the way, depending on how much duration they took. During 01, I think most of 2000 and 2001, the 5-year traded under 1%, as low as about 30 basis points. That means that 4.5-year duration product, if you bought it, was going to probably be between 30 basis points and 100 basis points. You can't make a living on 30 basis points. It's not going to work, okay? The portfolio that SVB sold, the AFS version, 20 billion, had a 3.5-year duration and had a 1.79 book yield, okay? That, I'm telling you, gang, is very conservative. It is probably on, I would say on all the portfolios I see, and this is, again, something that no one else gets to see, but only the people who, actually, not even bank CFOs, CEOs can see it because they can only see theirs. I can see many. My firm can see virtually all of them. And so we know what's going on underneath. I could tell you that 3.5-year duration on an AFS portfolio, I would be very happy with that as an advisor. To be sure everybody understands what I've done my whole career is I sell bonds to banks. I help them manage all these things that we're talking about, AFS portfolio, HTM portfolio. I help them manage that. I help them build it in a way that protects them from future fluctuation in interest rates. And we can get into avoiding credit risk, but we do that too. So I can tell you 3.5 is very good. They still took a $2 billion loss in that because it's a timing matter. Fed has raised rates, that raised it on the whole curve. We have inversions and all that, but the fact is their average investment rates are up 300, basis points. No way to avoid that unless you're forced to sell it. And the BTFP program alleviates that. You don't have to sell. You can bring it to us and we'll give you the money you need.
AFS means available for sale, part of where they park their assets available for sale. They're marking on the market. Held to maturity, they are not. I'm actually going to pull up the statistics so we can have the data on that. And Randy, you are saying that, sorry, go ahead, Randy.
No, give me a minute on it. Okay, So another misnomer. Now, Jack Mustafa was great, but here's an extremely intelligent guy who doesn't manage a bank portfolio's investment portfolio under FASB accounting rules. AFS and HTM is just an accounting thing. That's all it is. Has nothing to do with hiding anything. Anybody out there that says HTM is hiding losses, they do not understand. Those losses are reported on 10Qs and 10Ks every single time. Stop it with that. It's nothing nefarious. It's an accounting measure, which is a measure of GAAP capital and tangible equity. What it was FASB was trying to do was give a little insight into maybe some of the underlying risk banks might have in extraordinary circumstances where they have to sell these securities. That's it. Nothing's hidden. That's all it is. So you can more or less just put that to bed. It's an irrelevant thing to this current situation we have. So there you go.
Right. And so I got the numbers in front of me. So as of year end 2022, Silicon Valley Bank had $26 billion of securities in its available for sale portfolio. And yeah, the duration you cited is correct. And then in its hold to maturity, it had $91 billion that had a duration of 5.7 as of year end 2022. So yeah, the duration was lower. Yeah, because of negative convexity, duration increases, and duration is interest rate sensitivity related to maturity, but not the same thing. And roughly, correct me if I'm wrong, but a duration of 3 means that your portfolio of loans of assets declines 3% in value as interest rates rise by 1%. So if interest rate went from 1% to 2%, you have a duration of 3, a $100 million portfolio, you'd lose $3 million. Joseph, you wrote an excellent article on your fantastic blog, fedguy.com. I think the name of it was called Hidden to Maturity. And Randy just said HTM is not to hide losses. So what do you think?
No, Brandy is exactly right. So the assets of a bank, say loans and securities, fluctuate basically according to interest rates. So let's say you have $100 in par value of a mortgage or a treasury, and the interest rates go up, the market value of that would decline. Not just that, but if you made a fixed rate loan to a corporation and then interest rates rose afterwards, then the market value of that loan would also decline. So the assets of a bank balance sheet always fluctuate. The thing is that because of data limitations, from the outside, you don't actually see that day to day. If you are a bank and you put your assets in available for sale, then that's marked to market quarterly. But if it's held to maturity, then it's never marked to market.
Banks they can come to me on a daily basis and see exactly what their unrealized losses or gains are. We have a system that does that. So they'll report that quarterly or annually, but trust me, I got plenty of calls. I'm going into a board meeting. What is today's unrealized gain or loss? Which, by the way, with the 10-year coming down from 4 something to 3.5, has been alleviated to some degree. We're in such a small little world. What my industry does, there's no way, there's nobody other than us could possibly know that that's possible, and that's why I'm here.
Just as Randy noted, if you're an outsider, you don't actually see this. The bank sees this every day, but if you're an outsider, you don't actually see that. So it's opaque, and that's usually okay because we expect the bank to do a good job making sure that they have enough liquidity to manage their outflows, even though as outsiders, people who either deposit in the bank or own the bank stock don't see the fluctuations in their asset values. But if you're buying something that has no credit risk, even though the market value declines with higher interest rates, over time, the market value will converge towards par value because eventually that $100 in treasury securities is going to pay $100 because the US government has no credit risk. So as Randy suggested, over time, these banks are going to heal. These unrealized losses will disappear and it will converge towards par. So part of this is a timing issue, and maybe as Randy suggested, having these emergency lending facilities is a way to buy a bit more time for these banks for their balance sheets to heal a little bit.
You're absolutely right, Joseph. Very little credit risk. People are going to get paid back. Again, mortgage-backed securities, not the subprime CDOs from 2008. This is agency explicit or implicit guarantee of the U.S. government. Credit risk, not really an issue. But you have that interest rate risk. And yeah, let's say you buy a Ginnie Mae and it goes from $100 to $78. You can still mark it on your book at $100, but there is a loss there. And when you get paid back, you will get paid $100, but there's the opportunity cost of not being able to buy a Ginnie Mae that now yields 6% instead of 2%. And that should be reflected. If I bought TLT in April 2020 at $170 and then last fall it's at $93, in my brokerage account, that's a loss. But the banks don't have to do that, Randy. Tell me what I'm missing.
Well, it's not a loss to you unless you sell it, Jack. Okay, so you have to understand, nothing's a loss, nothing's a gain, by the way, right? How many times have I seen that? Oh, I made this much in the stock market this year. Well, did you sell everything? No. Well, you've made nothing. Okay. Loss and made, unless recognized, are not a real thing. Okay. On both of what Joseph said and what you just said there. So here's the situation when we talk about time is, and this is the point I've been wanting to really get across to everybody. I've been talking about on Twitter is in March 2020. Okay. We got, and by the way, there was situations, the market, I think we were headed into a recession in late 2019. I almost feel like 2020 basically ended that, because now comes all these extraordinary efforts, both by the Fed, all central banks, and the government's printing money, So March 2020, my clients have a lot of money to invest. And here comes the Fed and says, okay, we're going to take rates to zero very quickly. Not only are we going to do that, but we're also going to start buying trillions of mortgages, which means you got the biggest buyer ever to exist in the history of the market now putting their foot on spreads. That means yields of those investments are going to come down. We're going to hold them there for 2 years. We don't know, we don't know that for sure, but lower for longer. That's what he said. We're not even thinking about raising rates. Thank you, somebody on Twitter who reminded me of that. What, as a bank, are you supposed to do? You have to figure that's going to be the case. So you're gonna invest in some duration, and so I go out and when we talk about, everybody thinks that SVB was buying 30-year mortgages and they see 30-year as a final. Oh my God, they bought 30-year. That's not. The duration is what matters. And they probably did not buy a bunch of 30-year paper based on what I saw in that AFS portfolio. But point being is any duration I buy in those period of time is at the lowest yields ever. Okay. Now let's understand this. Not only, what I just said, rates to zero, mortgage spreads tightening. Guess what? The entirety of the United States mortgage market gets to refi their loans. And pretty much they all did. Okay. That means the bank's assets, one of their main asset categories, not only on their lending side, but also on their my world, the portfolio side, all those assets are now repricing. Okay, the entirety, almost, I would guess 80% of all their assets repriced, lowest rates in history. No way to avoid that. Also, by the same time, in March 2020, my frustration was, why are you buying mortgages? I know the prices are coming down, and I won't get into the weeds, but let's say prices are on a certain coupon mortgage is 102. They start to get down to par, 100 cents on the dollar. My accounts are buying hand over fist. Great for me. Well, then all of a sudden, the Fed takes that price in like a week from 100 cents on the dollars to 105 cents on the dollar. Okay. That's cataclysmic movement. I mean, now that you just raised the price, lowered the yield dramatically for all my accounts who have a ton of money.
And because of quantitative easing, because they were buying those things, so 100 to 105. Right. Yeah.
Right. Okay. Now all my mortgages, loans that I had out there repricing, all the loans I've been doing are repricing, everything's repricing because of what the Fed did. All right. You had to save the world with this pandemic. Okay. Why did you have to buy mortgages though? I don't be stimulative. That's a whole nother conversation. But my guys had the money. Then what happens? Then we get stimulus from the government. Now we get $1 trillion+ in deposits, if not more, based on QE. And that's a function that Joseph knows more about than I do. All I know is we got all these new deposits. I had banks in a 2-year period of time double in size. Normally they would grow about 5%, 10% each year. They doubled in size in 2 years. That means all those new assets are having to be priced, invested at the lowest rates in history. Fine. Everybody's like, well, they were warned about higher rates. Bullshit. They weren't warned until way after the fact. They could have been warned at any time. It just doesn't matter. Rates go up 500 basis points. Now, all of those things are at unrealized losses. And now, on a delayed function, all my deposit rates, all my funding rates, my ability to fund those assets, because they have to be continually funded, all those rates are now going up. Okay. And this is it. And that's so what I need then is time for my assets to reprice to the new prevailing rates, and I'm fine. I'll be fine. All your deposits are safe. They're good. We just need no panic, because under any scenario in the history of the world, nobody can survive a bank run. So we have to make everybody realize community banking is very safe. And I will tell you guys, SVB, Signature Bank is not community banking. They're not even close to community banking. So just get that out. They were, in my mind, if you really dig into it, they're probably closer to a hedge fund. So that's why we stand now. So what's going to happen? I'm just telling you what's going to happen over the next year or two. We're going to get, with time, that this situation's going to heal. The Fed's going to start cut rates. Both of those things are going to heal this unrealized gain loss situation. And hopefully they don't cut to zero, that they cut slowly, which all this means banks readjust pricing, bring back the asset liability, net interest margin back into something that's manageable. It'll be fine.
If you've been listening to Forward Guidance, you probably know that US Treasury yields surged higher last year. Right now, you can get a 4.8% yield on your cash with Treasury bills. That's pretty good. It's even better than what you get with a traditional high-yield savings account. So owning US Treasuries is great, but buying US Treasuries is super complicated, or at least it was. You used to have to go to a bank or navigate a government website that looked like it was designed in the 90s. Thankfully, investing platform public.com has changed all that with the launch of Treasury accounts. Now you can move your cash into US Treasuries right from your phone. And you can do it with the flexibility of a bank account. There are no minimum hold periods or settlement delays. In other words, you can access your cash whenever you want. And the best part is that because it's government-backed Treasury bills, it's an incredibly safe place to park your cash. Public will even automatically reinvest your Treasury bills at maturity, so you don't have to do anything to continue growing your yield. So to get that 4.8% on your cash, go to public.com/forward guidance to move your cash into a Treasury account today. Thank you, and let's get back to the episode.
I think Randy makes a really good point. Silicon Valley Bank was kind of like a huge mortgage REIT, right? Except that mortgage REITs, they borrow in wholesale funding, let's say repo and buy agency-backed mortgages. These guys were borrowing and deposits, investing in mortgages, except unlike a mortgage REIT, they didn't really do anything with their interest rate risk. But I think Randy makes a really good point about the net interest rate margins. So usually we think of higher interest rates as good for banks, right? So interest rates are higher. Usually, deposit rates are very low. They don't. So if the Fed hikes to 4% interest rates, deposits still remain about, let's say, 0 or 1%. So we usually think about higher interest rates as widening the net interest margin of banks and increasing their interest income. But that's not the case if you are a bank who bought a whole lot of low-yielding securities that have a long tenor. So back in 2020, 2021, if you're a bank and you bought a whole bunch of mortgages and they have very low yields, then when interest rates increase, eventually you're going to have to pay your depositors more, right? But your yield on your mortgages, they don't really increase. They're an asset that doesn't mature. And because prepayments are so low, maybe they won't mature for some time. So in effect, if this continues, you can easily have a lot of banks in negative interest rate margins, right? And that will bleed. That will cause them to have operating losses and will, I guess, reframe their ability to create credit.
That shouldn't happen, though, Joseph. I mean, that's actually probably Armageddon, because negative interest margin means you're not making any money and the game's kind of over. It'll compress, and so that means that's not great, but it's we can survive, and when you say mature. Every dollar, when anybody in the world pays their mortgage, right? You got interest and you got principal. The amount of principal that you pay on your mortgage payment, you are maturing that amount of money. That amount of money that you just matured goes to the bank and they get to reinvest that at the higher prevailing rates. So, I know
mortgages are amortizing. So right. Eventually over time, through your mortgage payments, the banks will receive that principal, those low yielding securities will pay down, and the bank will have the opportunity to take that and reinvest in higher higher mortgages. So like Randy mentioned, they just need time to heal. Then they can keep their net interest margins healthy, and they'll be in good shape to continue to create credit and support the economy.
I just want to say that, yeah, loans for Silicon Valley Bank really weren't the problem, at least on the most, the last financial, unfortunately, documents that they filed. I think their capital call lending business, which was over half of their loan book, they had one default in the history of the entire business. It really was all about duration risk. Joseph, I know you're an extremely polite guy, and Randy is making a very articulate argument, but there was a time, a week ago, where you said it's elementary, the interest rate risk mistakes that they made. I mean, if you were someone who had easy conception of interest rate risk, you would have hedged that book. Why was the interest rate hedging so negligent, if that is an appropriate word to use? I mean, they didn't have a risk officer for most of last year. Please go, and then Randy, Joseph, and then I want to hear your response, Randy.
Yeah, sure.
So I think from an accounting perspective, once you put something into held to maturity, you don't actually hedge that. So I think they made a corporate decision once upon a time to just, well, they have a balance sheet of 210 billion. More than half of that is in securities, and a whole bunch of those securities were in held to maturity. So they were just kind of, I guess, they were made this corporate decision such that they didn't think interest rates would rise, or perhaps they didn't think that their depositors would run. Because the other side of this equation is that if nobody ran from Silicon Valley Bank, even if they had large unrealized losses, they'd still be alive with us, or they'd still be with us today. So it does seem odd to me that you would have so much interest rate risk and not do anything about it. But from what I understand, speaking with Randy, this is common practice among the regional banks and smaller banks, is to not hedge their interest rate risk. It's the more the GSIBs that do things like that hedge their interest rate risk.
Right, GSIBs, globally systemically important banks, the big guys, J.P. Morgan, Goldman Sachs, Bank of America. Randy, all right, so it's spring, summer of 2020. These banks, they buy these mortgage-backed securities. Do they take a lot of duration risk? That's fine. Jay Powell is saying lower for longer. We're not even thinking about. But what about when the siren song, the call of, oh, actually, inflation is getting serious, transitory, we're going to start tapering the balance sheet? What about, let's say, January of 2022? Why not put some serious interest rate hedges on, as Joseph said? Why wasn't it negligent of Silicon Valley Bank to not put those hedges on?
Okay, so this is, I'll give you a skin in the game answer first. If I negotiate a hedge for my clients that would go through my derivatives desks, I will make a commission on that. So in my career, if it was wise to do so, I would be doing it because I'd be making money. Okay. And so would everybody else in my industry. So would all the derivatives desk, the guys, so look, if they would be doing it if they could. Let me first say, okay, so and Joseph, I love you to death, man, but I'll push back to you on this one. Had they done this, SVB would have survived. No way. No one can survive a run. End of story. Just, I don't care what you've done. There's no way to survive it. Even if, by the way, the BTFP program existed, they still would have failed because they had 49 billion deposits roll out. They had, that was accelerating. They only have so much collateral to work with. At some point, the deposits outweigh your collateral and your borrowing capacity. The game's over. Okay. So with hedging is extremely complicated when you're dealing with unknown cash flow in the entire portfolio. Not only, like Joseph said, not only on your funding side, but on your asset side too, or on vice versa. But so that's extremely difficult. The more optionality there is in those cash flows, okay, with mortgages, because we all have the ability to call our mortgage by paying it off. And the more you add to that, the more expensive those derivatives are going to be. And by the way, also at any point, if you guess wrong and you hedge for higher rates and rates go lower, now you really got a problem. Okay. There's no way to perfectly, on the whole, manage this interest rate risk. Look, community banking is no different than George Bailey's bank. It's the exact same model that has always existed, and it's always been an exposure that this system borrows short, lends long, and there's always going to be this mismatch exposure. We've just never had the violence. Okay, so let me tell you what the perfect hedge is. It costs you nothing. And this is what I've been talking about this whole time. The perfect hedge is, and this is my job, is to create consistent, predictable cash flow in your portfolio. That way, if rates go up, I have a certain amount of cash coming back that I can reinvest at the higher rates. I'll even give you a number. My rule of thumb has always been, and this was after probably 10 years of being in the business, I figured this out. I look at a guy's portfolio and I say, I want 60% of your cash principal coming back to you in 3 years. I think that's a really good way to do it. That way, if rates go up, you're going to be okay. Now, let's say right now, I might go to those guys and say, you know what, let's make that 40% of cash coming in, because that means I'm going to lengthen my duration, because I'm starting to feel like we know where rates are going to go. So that way, if rates go down, okay, I still have to reinvest those cash flow at lower rates, but not as much as before. But what I'm doing is ebbing and flowing with wherever rates may go. That's the perfect hedge. That's the best hedge you can do. Interest rate hedges on certain sectors of lending are possible, and they can be perfectly matched, but that's about it. Not on the whole, no, guys, there's no such thing.
So that reminds me of our discussion with Harley Bassman, Jack. I recall that the spread between mortgages and treasuries, that's unhedgeable. So, and as we've known, that spread has been volatile over the past couple of years. So even if those guys put on hedges, it would have been a difficult thing to do, as Randy mentioned.
It's a mitigator, but it's not a savior. And it compresses NIM. And so when you're already having compression in NIM back in net interest margin in 2021, you're already having to go with, okay, well, I'm only going to make 100 basis points. I'm not used to that. That's pretty low. My ROA is going, return on assets are going down. Wait, you want me to pay that's even going to kill that even more. And we don't know that that's going to happen. And Jack, when you get in, as soon as they say we're going to raise rates, guess how much your derivatives are going to cost now?
More expensive, and volatility going to go up, move index. Yeah. Right. Randy, I'm going to sort of be a little harsher than I would, just for the sake of argument. It's not my fault that I didn't buy car insurance. Like, it's too expensive. Yeah, but the value of your car is predictable. Okay. The value of a mortgage-backed security or any interest rate sensitive asset is unknown. So that there's another level of option that we don't know. Thus, the derivative is ghastly more expensive because we have to make up for the unknowns. Right. So Randy, you said you like it when clients get 60% of their cash flow within the first 3 years. It's a shame that someone like you weren't being listened to by Silicon Valley Bank, because I'm looking at their hold to maturity portfolio, and $86 billion of their $91 billion hold to maturity portfolio had a maturity of over 10 years. I know duration matters much more than no. It matters incredibly. It not just a little. Like the maturity of their assets, I'm assuming, let's say they're mostly mortgages, is incredibly irrelevant. It's the duration that matters. And I think you looked it up when we talked the other day. Their duration of that HTM portfolio before the Fed hiked rates was 4 years. Again, that's fair. That's pretty much middle of the road for all banks in the United States. I would say most banks in the United States. And now it's 6. Unfortunately, I can also tell you that that's probably on par for a lot of the banks in the United States. So yeah, they were doing, there was nothing weird in their portfolios at all. I promise you. Joseph, I want to get your thoughts, as well as I'll just throw out the arguments on Randy's side of someone has to bear the losses. When the Federal Reserve raises losses, it's imposing losses on itself, which it will not realize, but because it owns so many treasuries, mortgage-backed securities, and it's paying the reverse repo rate, the overnight rate. But it's going to impose losses on some banks. And if Silicon Valley Bank had hedged its risk with Goldman Sachs would have had that risk. They would have sold that risk to someone else. Someone's going to end up holding the bag of rotten apples. So it's systemic. What do you say to that, as well as just Randy's general argument?
No, that's how monetary policy works. It's one of the channels. You raise interest rates, you impose losses. There's a negative wealth effect, and someone somewhere has less wealth to spend. We saw that happen with crypto. We saw that happen with many meme stocks. So you hike rates, someone somewhere has less money to spend, and maybe that decreases demand. Maybe that slows down inflation. I think Randy makes very good points on the asset side of the bank's portfolio. It's hard to hedge that, and especially if you are a community bank, maybe you're not used to doing something like that. So I think one thing that I would fault on these smaller banks would be how they manage their liabilities. Now, broadly speaking, the community banks have a deposit base that's insured, so they don't really have to worry about what happened with Silicon Valley Bank. So I think SVB really is, as Randy suggested, an outlier. They're running themselves not so much like a bank, but more like a giant investment fund. But I'm actually really curious about Randy's perception as to whether or not what happened with Silicon Valley Bank is changing the behaviors of any of the medium or smaller banks. Are they thinking about their assets differently? Are they thinking about their decision to hedge or not hedge differently?
Well, first off, I would say I find it really interesting the clairvoyance everyone has at the risk of having a high percentage of uninsured deposits on your liability side. Prior to Silicon Valley Bank, in the history of banking, no one's ever commented on that. No one's ever saw that as a problem. So yet everybody's like, well, there you go. They should have known. No one, come on. And there's a lot of other banks that have similar percentages. They were the highest, no doubt. And I think that was just a good way to say, look, it's their fault. I think their faults lie in other places. But even so, and Joseph, I think you said this yesterday, that on the whole, 50% of deposits are uninsured. Okay, so is 50% better than 85%? I mean, if the 50% disappears, you're still dead. So I want to get away.
I'd add something else. The banks that have the highest percentage of, on average, highest percentage of uninsured deposits, they are the GSIBs. So they are the too big to fail. So you kind of have everyone going there and being, whatever, uninsured, the government will bail me out. Banks that have the highest percent of deposits that are insured are the smaller banks.
There's some bigger banks out there promoting the fact that, hey, we don't have that uninsured risk because 95% of our depositors are actually insured. I mean, under 250K. Okay. And okay, great. That's great. But let me just tell you something. If you look at history, if you look at, I don't know let's just say IndyMac's a good example. Now, you could say what you want about their assets, but it took one comment from one senator to kill IndyMac in a heartbeat. Okay. I forget what senator it was. He came out and said something to the fact, I'm concerned about the level of subprime lending that IndyMac's been doing. Done, over, closed the doors. That was it. Okay. There was a run on the bank. Didn't matter if it was uninsured, insured. Your mom went over there. Everybody went and took their money out. Game over. My point is, you can never know what comment or what event can cause a run on a bank. So that's why I'm pointing out this uninsured thing. Is that going to be looked at? Yeah, they have to now because everybody's now all of a sudden going to look at it. Yeah, okay, so that's a thing, whatever. You asked a specific question, Joseph, about hedging. Most certainly it's going to be looked at. Most certainly they're going to start to engage us and say, this, that, but still, on the other hand, it's not going to become pervasive. It's not going to be this this holy grail of, it's just, it cannot be. It's not going to exist like that. I do think, Joseph, you're right, though. One more thing. I think they're going to be a little bit more careful about the level of on-demand deposits they have, right? So when you mentioned CDs and other forms of funding, even though they're more expensive. So now remember, we're in 2021, when you do those term funding, meaning you lock in funding for 2, 3, 4, 5, 6, 7 years, whatever, in CDs, you're stuck with that too. And you're in an environment where you're like, can rates go even lower? That's bad because now I'm stuck with that, whatever that could have been 2%. And if all of a sudden now any investment I could get my hands on is 1%. Now I'm mismatched again. I'm on a negative NIM on those amount of dollars. So, but I do think you're absolutely right. I think that's where they're going to pay more attention is, can I manage my my liability funding a little better? So, we're not getting into this, but I guarantee you what people are probably going to be looking at is issuing callable CDs. If I issue a CD and it's got a 1-year call, in 1 year, if rates are lower, I can say, hey, here's your money back. And if you want to, instead of 5%, if you want another CD in the same term or whatever, it's going to be 4%. Then I'm going to call it again the next year. Now it's 3, now it's 2. That gives them the ability to lower their funding costs as rates go down. That is the beauty of this new facility, is every time it goes down, I have the ability to call it in my favor as the borrower and say, hey, I want to lower my rate. I want to lower my rate. I want to lower my rate, because I'm the one borrowing it. So it's a type of call. That's the kind of stuff they're going to look at is how can I make my, that's such a good point, Joseph. How can I make my interest rate sensitivity on my liability side more robust? Okay, I know Randy's helping me do it on my asset side in managing the cash flow of my portfolio, but how can I manage the cash flow, which is essentially what it is, on my borrowing funding side? And that's where I think the attention will go more so than hedging.
So it would be better if a bank were funded with long-term issues of corporate bonds. Goldman Sachs issues a 10-year bond. It's more expensive than non-interest-bearing deposits, but it's safer because you have to have it locked in.
If I lock in my funding and all of a sudden, do a 10-year fixed funding at 5%, and all of a sudden rates go to 2%, no, that's a negative.
Right, but it's a positive if rates go from 0% to 5%. So if Silicon,
right,
yeah,
but you can't make that guess. A bank is not in the game of guessing where rates are going. They're in the game of trying to create a robust cash flow so they can ebb and flow where rates are going. That is not their business to bet where rates are going.
So a callable CD, for example, let's say I invested in a callable CD today at 5%. Then if rates continue to go higher, the bank is happy because, well, they don't have to pay me anymore. But if rates go down, the bank can buy that CD back from me, right? Let's say rates go back to 0. And then now, poof, the bank doesn't have to pay me 5%. They bought that CD back. They can pay me 0% if they want. So it's a good idea where the bank can manage their liabilities, and also because it's a CD, I can't take it back whenever I want. The bank has discretion to do that, so they're not afraid of runs. It's a easier way to manage their liabilities and interest rate.
Right. And Joseph, the chart that we put up earlier from fedguide.com showing how it's the bigger banks that have the higher percentage of uninsured deposits that would be more prone to bank runs. That is correct. You're absolutely correct in the macro sense, but I think it is the case that the banks that have 80%, 90% uninsured deposits are not JP Morgan or Bank of America. I think Bank of America is something like 30%, these consumer banks. Those are specialty banks that bank to large businesses and funds like Silicon Valley Bank, Signature Bank, and I think First Republic. I don't think it was 90%, but large percentage of their deposit base was 80%. So, Randy, how big? We know what happened to Silicon Valley Bank. We know what happened to Signature Bank. What do you think is the risk that more banks fail? And I suppose that the bank really in question now is First Republic, that had a large percentage of uninsured deposits. That there was a minor bank run. The bank's stock collapsed. It's secured funding from the Federal Home Loan Bank for posting its mortgages as collateral. Interestingly, it made use of the FHLB. It made use of the BTFP as well as the discount window, but it didn't have as many securities as a percentage of its whole book, like Silicon Valley Bank. So Randy, what would you say is the health of the banking system now? How do you see things going forward with First Republic, all the issues I just mentioned, as well as the other banks?
Okay. So a good way to answer that, let's talk about First Republic, PacWest, who are experiencing issues. I'm going to assume, I would have to guess I'm probably right on this, in that they're fine. It's a normal community bank, What is their problem? Well, the problem is twofold here. One is that somebody, somewhere, when Silicon Valley had its problems, immediately said, oh, wait a minute, there's the issue. They have a high level of uninsured deposits, which has never been a problem for the history of banking. I mean, all of a sudden, oh, well, no, that's a problem now. And they do a lot of VC and tech. So you take like PacWest, I'm not even sure where First Republic is. I think they're in California too. Okay, wait a minute. Oh, I see. You know who's at risk here? Who has a high percentage of uninsured deposits in Tech Valley or exposed to that? Oh, there they are. Dun, dun, sell. Okay, that's it. And this is what I said earlier, is that a bank runs can start with the most, innocuous comment from somebody of authority, and all of a sudden you have a bank run. And so that I would have to guess, I know all my banks are fine. All my banks, they have this exposure, but it'll, with time, it'll be fine. So that's what I think you're seeing there. And right now, I guess the regulators are like, and Fed, and they're trying to figure out how to, they probably see the same thing. That's why they haven't been forced merged with anybody. That's why they haven't been taken over by the FDIC, because they know, God, these guys are fine. We just got to find a way to get people to calm down. And that was the point of the BFTP.
Right.
FTP,
and so when you say these guys are fine, just an example of First Republic, stock fell from over 100 to now trading at $12, and right.
I can't say go and invest in that, because
quite sharply.
Who the hell knows?
Right. The deposits could be fine. The bondholders could be fine. The bank will still exist. Maybe it doesn't have to be taken over. But when you have a $50 billion outflow of close to zero cost deposits, and that has to be replaced by borrowing from the FHLB, the Federal Reserve, and JP Morgan, and all of the other banks, that it makes sense why the stock is going to make less money.
Right. Yeah. If Mr. Rogers had a bank, he'd still have the same exposure. It's just, everybody's got this exposure. And, I kind of, if my assumptions are right that, FRC and PacWest are fine, this is a shame, man. This is really bad. It's bad for a lot of people, a lot of investors. This is just not good. And it was unnecessary. And I think, look, if I wanted to be a conspiracy theorist, my opinion is that the powers that be, with Fed, the Treasury, whoever, the FHLB regulators, they needed to point to something to say, look what you did to yourself. In my opinion, no, actually, they're exposed because, they have all these losses, unrealized losses from what you did, from, all the last 3 years. It's an exposure that you subjected them to. Again, that would be assuming that SVB doesn't have anything else going on, which I think they might. And I think that's why the rats were fleeing the ship.
Joseph?
I think Randy makes a really good point about a bank run being in part psychological. So like we discussed earlier, like if you work at an investment bank that serves the bank like Randy, or if you're the bank's management, every day you can see the asset values of the bank. But from an outside perspective, the depositors, they don't know. All they do is that they see something bad happen with Silicon Valley Bank and they get scared. Now, one thing that we should note is that the banks that are having a lot of trouble right now, First Republic and Westpac, those are all California banks. So what could be happening is that, someone knows someone and they chat with each other and they get scared. So in that part of the country, there seems to be concern spreading among the public. And so they're to be safe, they're going to shoot first and ask questions later.
Yep, that's right.
But that seems very much to be regional, as Randy mentioned, and Randy's based on the East Coast. Everything outside of that California region seems to be okay.
If you are driving to work or going to see your grandma or something, and you drive past a bank branch, any bank branch in the history of man, and you see a line out the door, once you've confirmed they're not giving out donuts, you are going to get your money out of there as fast as possible. And with smartphones these days, which, by the way, other people made the joke, I did too, apparently, Yellen does not have a smartphone because she doesn't get how swiftly, deposits can be taken out of your bank now. It is a new world. It means the run can happen a lot faster, a lot more intensely than it ever could in history. And, that's a little bit of a problem.
That, to your point, I think Credit Suisse was blaming social media for fanning the huge bank run in Credit Suisse that forced them to collapse basically over the weekend. So, people have smartphones. information passes quickly, and everyone can just log in and wire their money out really easily. So there does seem to be some aspect of this.
My mom obviously knows I deal with strictly banks for the most part, and she, about an hour after Silicon Valley Bank came out, the news, she, oh my God, is this going to affect your business? I'm like, oh God, Mom, turn off social media, turn off the TV. It's all going to be okay. The other thing that infuriates me is that you have financial media out there, and on TV, one guy in particular who names his dog NVIDIA, saying that all these banks bought bad assets, and then it worries mom and dads and grandmas because they're at home with CNBC on, and they hear that and they panic. It's irresponsible to say that, because it's incredibly not true. You're flaming the flames of panic, and you're doing so from an uneducated, unknowing platform. But you think it's going to get you clicks and tweets and retweets, so that's what you do. It's incredibly irresponsible for that kind of behavior, and I see that throughout financial media and on FinTwit. And that's why I'm fighting against it, because don't do this to yourselves. It's unnecessary. Community banking is good. People out there going, well, we just need to go to 4 big banks, or we just need to go to government banking. That's ridiculous. You have no idea what community banking is really about until you're on the inside of it, like I am, and really see it coast to coast, how important it is for community banks to exist.
What about the rationality of irrational behavior? If you see a line outside a bank and they're not selling donuts, even if you know that the assets of the bank are the bank is solvent, even if you have less than $250,000, the limit on FDIC insurance, you get up in a frenzy, and then someone says, oh, Jack is up in a frenzy, I should go up in a frenzy too. And then this cascade feeds on itself. And yes, everyone in Silicon Valley is on Twitter all the time, very plugged in. You're probably more familiar with how to withdraw money with their phone than some people on the East Coast.
I totally have a comment on that. And I'll do it really quickly, because it's something we should have another podcast about. But look, I'll do it real fast. Bernanke's essays on the Great Depression came down to 2 things that could solve the problem. We cannot have the visuals of what you said, of irrational behavior. If I see a visual of a soup line, I'm probably going to irrationally hunker down. If I see the visual of a crashing stock market, even if I don't have any stocks, that visual is going to cause me to be irrationally frugal. And that was Bernanke's sort of the summary of his studies on the Great Depression. And that is why I believe Bernanke, when he took over, said, we are going to manage markets. We are going to do forward guidance. We're going to do interviews. We're going to do everything we can to prevent the visuals of ever occurring that something's wrong. Because if we allow those visuals to happen, people will irrationally panic. And I think that's what they're still, and the problem with that is that the deeper you get into that, I mean, that is the Fed put, that is moral hazard. That is a problem, is that everybody's relying on you to don't let me see bad things. And as that goes on, the bad things that should have happened, at least in a managed way, are not happening, and it's getting worse and worse and worse.
No, I think that's absolutely true. And we're kind of seeing this play out right now, right? So Silicon Valley Bank went bust. Now everyone is hyper concerned about the asset portfolio of their banks and whether or not the banks have a lot of insurance, whether or not they have a lot of uninsured deposits. So there is that feedback mechanism that's having at play now. And it's good, though, that we have bad things happen every now and then. That's how we know that there are things that we need to be careful about, need to avoid, and that's how we can fix the system.
I think what you're going to find out in the end game is that I've I mean, this is sort of clandestine, but there are people on Twitter in the know. I am one of those people that are in the know about my little world. And somebody sent me something kind of showing me the flow of money that was around Silicon Valley Bank. I think there's more interesting things to come. And I think what you're going to find out is it had absolutely nothing to do with uninsured deposits. It's going to be about things that we were unaware of. that we just didn't know existed, and it's going to hopefully make people realize, you know what, my deposits are fine. You know, what it has done though, Joseph, and this is something that I think you'll appreciate, is that I have a friend of mine, he's a big home builder and multifamily, single, and all that. With what's going on, and he's on my email blog, he called his bank and said, "Tell me about the losses in your AFS and HTM portfolio." He is a large depositor. That is why we're not insuring him. That's the spirit of insuring up to a certain amount, is if you're going to have more than that, we need you to be invested in your bank and asking your directors and your contacts, hey, tell me about this risk or that risk. You know, I'm going to go to your annual meeting. I'm going to pay attention. That's what we need from you. And that way you're part of my ability to measure what's going on. The regulators can't be there every second of the day. They can't be asking these questions every second of the day. We need your help. And so I think this idea of 100% insured deposits is a horrific idea. Now, let's see. Money's about, by my estimate, 4 times larger than it was when we went to 250. So clearly, I think that number should be larger. But 100%, I think, would be a horrible mistake. And I know, Joseph, you've made some thoughts on that as well, comments.
No, you're exactly right. I think that it's good to have these market mechanisms, these feedback mechanisms, where we can basically use market forces to police actors, to make sure that these banks are behaving well. If we were to guarantee everything, then what would happen is that you would have banks go and do, a whole bunch of risky investments. And that way, if the risky investments turn out well, then great, I'm going to make a lot of money. But if they don't turn out well and the bank goes bust, then we'll have the Treasury bail out all the depositors and make them whole. And it's kind of like another version of, the upside gets captured by the people who own the banks, and the downside is paid for by the public. We don't want that to happen. And I think a bigger question is that, and this is, so in the background, we've been talking about central bank digital currencies, right? That's all the rage in many parts of the country, many parts of the world, especially in more, let's say, authoritarian countries like the People's Republic of China. Now that we have these clamors for 100% insurance, we can see a stronger argument that people will make towards some sort of centralized central bank digital currency, where we would all have checking deposits at the Fed rather than a commercial bank. So that's something that could be unpopular as well.
Help me understand something, which is a lot of folks saying about how turmoil in the banking system could cause banks to curb their lending. And when banks lend a lot, that's a inflationary, reflationary boom. And when they cut off credit, that's a deflationary, and it can lead to a recession. Joseph, I think I first heard that idea in our talk with Stephen Moran, one day after the emergency measures, not going to use the term bailout, of FDIC Fed on that Sunday. And now I think it's become increasingly mainstream, as it's so much so that the Federal Reserve, Jay Powell, yesterday said we actually expect, or we're anticipating, some contraction in credit.
Obviously, Chair Powell watches forward guidance, right?
Well, forward guidance watches Jay Powell, that's for sure.
I think Stephen's point is really good, and it was echoed by Chair Powell. So banks create money out of thin air when they make a loan or buy an asset. And so when banks create a lot of credit, we have more money in the financial system. More money means more demand for goods and services and for financial assets. And as you mentioned, Jack, that is reflationary or inflationary. So, but whether or not a bank makes a loan is dependent upon many things. One, of course, you want to have profitable lending opportunities. You want to have people who are willing to borrow. But also, the bank is concerned about its own health as well. Now, right after the great financial crises, the banks, even though interest rates were low and there was demand for loans by some sectors of the economy, there wasn't a lot of credit created because the banks were on life support. They were not in good shape. They were not in a position to continue to make loans. They had a lot of bad loans on their books already. Today, what may be happening is that some banks are concerned about their survival. Think First Republic, think Pacific West. They're afraid that they might have, their depositors might run, and that fear might put a dampen on their willingness to create more loans. And so, if that effect is prevalent, we can just expect that this panic in the regional banks could have a dampening effect on credit creation and thus economic growth. And Chair Powell is thinking that might be equivalent maybe to 1 or 2 rate hikes. No one knows. It's really preliminary, but it has an effect of dampening down the economy. And so that's part of the reason that he thought that maybe we don't need to hike as much as he did before.
Randy?
It's already happening. I mean, that's what's frustrating about this is that, again, I get to see it way before everybody else does. And because I'm talking to my banks every single day, they're lending less, or at least they're going to remain stable, which is not inflationary, right? If you remain stable, you're not creating new money with new debt, new credit, whatever. And so they're remaining stable. Many are going to shrink. They're going to say, you know what, we're not going to, loan as much. We're going to go ahead and just, and a lot of those loans are funded by borrowings. No, cash flow comes in. We're just going to pay off the borrowings because we're trying to manage, this net interest margin. We're going to probably grow the amount of cash we hold on demand because of these issues with outflowing deposits. They know this. Powell knows this. He's not an idiot. And that's why I think there's a delay to their efforts, and they've done so much. I think that the recent hike yesterday, and even if I hope not one more, but I guess it doesn't matter at this point. I think it's just, hey, I want more room for when I do have to lower rates. I don't have to go to zero again. And that's where he got caught last time, right? He was raising rates, and I forget how high it got, but I don't know if it was 2 or something like that. And all of a sudden a pandemic hits, boom, we had to go to zero bound immediately. So I don't think he ever wants to do that again, because it creates a pricing dynamic that causes stresses as we're seeing. So I'm just telling you, man, lending is already coming down. They've done their job. They just should be the adult in the room and just give it some time.
Yeah, Joseph, how do you think this will impact the Fed's rate hikes if a contraction in credit, which is now anticipated, is equivalent to a rate hike or 2 rate hikes? So if a month ago the terminal rate was kind of close to 5.75%, which would mean 3 more hikes from here. If the contraction in credit is 2 rate hikes, that means only 1 more rate hike in May, and then we're good. How is your outlook on sort of the Joseph Wang Fed guy terminal rate changed?
I think it is impacted by this. And I think that, well, Chair Powell probably is right. He just probably has to stay around here and hold it throughout the rest of the year. But I think we have to keep in mind something else as well, though. So monetary policy affects bank credit creation and so forth. But in the US, at least, credit is created by banks, but a lot of credit is also borrowed through the capital markets. And so one thing to keep in mind is that as the market right now is aggressively pricing in rate cuts, and the 10-year is down a lot, then you could see mortgage rates come down, and half of mortgages are funded by investors in the capital markets. You can see borrowing rates by big corporate borrowers come down as well, and that has a potential to reaccelerate the economy. So right now, I think that the terminal rate, as the Fed projects in its dot plot, about where we are now, holding it throughout the year, makes sense. But I actually think my forecast would be tilted towards the upside, since the US is a lot more capital markets driven. And right now, where there's volatility in the markets, but as that shakes off, and as the market is convinced that rate hikes are coming, we could see sectors in the economy begin to reaccelerate, like housing, which reaccelerated very quickly in January once mortgages got below 7% towards 5%.
The Federal Reserve's discount window, as well as its BTFP, Bank Term Funding Program, is getting a lot of uptake from banks posting collateral, getting that funding. As a result, the bank's balance sheet is reaccelerating after the sort of slow fall of quantitative tightening. A lot of people saying this is quantitative easing, shadow quantitative easing. What do you guys think on that terminology? And then is this a net stimulus to the banking system in the same way that, oh yeah, if the Fed buys $1 trillion of treasuries and mortgage-backed securities, that's going to stimulate the financial markets and maybe the economy a little bit? Joseph, what do you think?
No, I think that's totally wrong. That's actually seriously wrong. So when the Fed does QE, you can think of it as adding excess liquidity into the system, and maybe someone somewhere takes that money and goes and buys risk assets. When the Fed is doing these emergency discount window lending, that's someone somewhere in the financial system not having enough cash and so desperate that they're taking out an emergency loan from the Fed. So that's not going to be money that gets thrown into risk assets or corporate bonds and stuff like that. So it's a negative sign. It's definitely not a positive sign for the market. But to be clear, I expect that to quickly reverse this week or next week, since it was very much a temporary measure connected with the desperate needs of Silicon Valley Bank and probably a few other related banks as well.
Thanks. Well, before I ask my last question, Randy, could you, like me, are a huge fan of Joseph's excellent book, Central Banking 101. Can you just tell us a little bit about how that book helped you already, a professional well-versed in these matters, your understanding in the same way that it helped me, who was, more early on in my learning journey? There we go.
Yeah. First, there you go, Joseph. I had it right ready.
Thank you, Randy.
By the way, let's just, let's look how all the highlighting, the notes I took, I read it carefully. I will first say that, Daniel DiMartino's book, Fed Up, is extremely important to read. And that was really fun because that was the first really look behind the curtain that I got from a Fed insider that opened my eyes up to a lot of things. And the number one thing I learned from Danielle was how little outside government data the Fed was getting. And she came in there and said, wait a minute, having been on Wall Street, she's like, wait a minute, there's so much more data out there in the private sector. Why don't you get that? And that's what she started bringing into the Dallas Fed, was this data that's out there and available and people willing to give it. And that was the big change she made inside. And it made me think, gosh, they only think in what they're given. They're not really going out to get more. What I learned from Joseph's book, and I'm just obviously just a highlight, and it's absolutely required reading for anybody in financial markets and business school, it'll probably be required reading, is I knew that there was coordination between the central banks because, the word transitory just doesn't automatically get used by a whole bunch of different central bankers. And I'm trying to think of other unique words they've used. And if you read particularly Bernanke's The Courage to Act, a very a title full of hubris, he talks about they would spend, almost comically, we would spend days going back and forth with emails trying to choose the right word that meant something but could mean something else. And so, and all of a sudden that word started getting used by all the other central bank leaders. I'm like, wait a minute, this is crazy. Well, what Joseph explained, I thought it was amazing, was the New York trading desk, and you can modify this, Joseph, or correct it, is that, probably the most powerful trading desk on the planet, maybe outside Goldman, that they would have, new traders from other central banks come into that desk for a period of time, learn, be educated, and then go out back to their prospective central banks. And that clearly demonstrates that there is a lot of coordination. There's a lot of communication. There's a lot of like, look, you do that first, then let me do this. And it's all, and I think that's important to understand, because then that forces us to have to watch other central banks' commentary around the world, because it's going to help us kind of get a feel for what's coming from our central bank.
No, for sure. There is a lot of coordination, as Randy noted. It happens at all levels between central banks. They chat with each other regularly. When I was on the Fed's trading desk, we would have periodic calls with all the friendly central banks and just kind of chat of what's happening, what we're hearing, and so forth. A lot of information exchange goes on. And I also would note that Danielle DiMartino's book, Fed Up, really good read. So what people don't often realize is that the information you get from the Fed, it's curated. If you are a journalist or if you are a bank, so a journalist has to say good things about the Fed to maintain access. A bank, well, they're regulated by the Fed, so they definitely have to say nice things. You only get one side of the story, and it's heavily curated. So people like Danielle DiMartino Booth and others who are no longer with the Fed, they're good sources of information about what happens there and how they work.
And you, Joseph, are also an excellent source of information. My final question, Randy, I would love for you to square two views that you've had. One is about the hedging within the banking system, that the regional banks with whom you have a lot of contact with, and you are extremely qualified to share views on this. The degree to which they hedge, and okay, yes, the very large banks, JP Morgan, Goldman Sachs, they are fine with interest rate risk. They don't worry about them. But the regional banks, they didn't hedge. But then you also say that you are less concerned about this banking panic, and you think that folks on CBC and Bloomberg should be less panicky. Mm-hmm. So can you help me square those two views?
Yeah, look, guys. First off, let's make it clear: the GSIBs are not community banks. You have to know that. It drives me crazy that people, when they talk about banks, or if they talk about bankers, they talk about Jamie Dimon, or Brian Moynihan. They're not. It's not the same thing, at all. So first, remove that. Next, all these regional banks of any kind of size. Yeah, hedging can mitigate, but that's it. It's not a panacea. And so, as long as you don't have panic, the perfect hedge for these guys on all their assets is consistent cash flow. And as long as they have that, they will ebb and flow with these interest rate movements and interest in inverted curves and all this stuff. It'll be fine. They're all fine. Yeah, and Joseph has mentioned this. Banks fail all the time, and those are the bad actors. They look, in the end, IndyMac would have failed anyway because they went 100% as far as I know, but they won a lot subprime lending, and they chose one segment of the market to get into. That was not a robust way to lend. And so I will tell you, those are the guys who get in trouble when they make a bet on a certain sector. There might be, I don't even want to say, somebody focused on one sector that could get in trouble, and they exist, and they'll have their own problems. The banking system on the whole is perfectly fine.
I also think you got to put your money somewhere. If you pull out from Bank A, you put it in Bank B. Yeah. There's only so much room in the mattress, and I think most people understand that the mattress is not a good place.
Here's the difference between, I think it'll help people, between an equity guy and a bond guy. Equity people, when they look at investments, they first look to good. What is good? What's benefit? What's the yield? What's this? What's that? Good. Then, okay, now let's see if maybe there's something bad. Bond guys are the opposite. Or they should be anyway. I've learned to go, what is bad? That's the first thing, because there's one thing that has to happen with all my clients. They got to get all their money back. Okay. They have to get their money back. Banks are not in the business of taking bets. That's, so a lot of them really don't do corporates anymore and things like that, because there is a chance, no matter how well rated they are, something happens and they don't get their money back. That's why most of it is on their investment portfolio anyway, is an agency, government-backed securities. So I just want you to know that is my job is to do that. But I feel my role in FinTwit is to let me try to temper enthusiasm. Let me try to temper maybe those guys who are their book is equities, it's bank stocks and things like that. Well, let me try to temper that a little bit. At the same time, they're tempering my negativity or my worries. So I think the combination of us two, don't ignore either of us. I'm hoping that both of us allows you to sort of develop your own opinion. And that is why I pretty much anything I put on Twitter, I'm giving to my clients too. I'm saying, look, here are the things I see. So be careful, pay attention.
Right. So just to conclude, Randy, you were saying that the somewhat widespread perception that Silicon Valley Bank did a bad job of managing its interest rate risk, and that is an outlier in the banking system. You were saying that with regard to regional banks, that is somewhat untrue, correct?
No, actually what I'm saying is I don't think Silicon Valley's problem was interest rate risk at all. Anything they could have done, it would only been a mitigation. Based on what I've seen on their underlying portfolios, I can't see their loan portfolio. Maybe there's disaster there. I kind of doubt it there too. I think the whole Silicon Valley Bank is a very strange happening with a very tight community of depositors who are very close. And I kind of feel like Goldman kind of made a mistake in going, I guess we got to raise capital because we're losing deposits. And they sort of gave information to all their depositors that they went to first to say, hey, we're going to do a capital raise. And they presented the idea of like, what do you mean we got losses in the portfolio? I didn't know that. And now all of a sudden it's a panic. So I think that there's such an outlier situation, but as far as this simplicity of managing interest rate risk, no, that's an exposure all banks have, and it will be mitigated by cash flow. And maybe from now on, maybe they'll look at hedging, but it'll still only be in mitigation. But with time, they'll always be okay.
Thank you, Randy. On Twitter, you are at the Bond Freak. Joseph, I'll give you the final word.
No, I'm going to leave it with Randy. That was well said. And I really appreciate Randy coming on and chatting with us. We don't often get people with deep expertise in regional banking, and that's definitely what we need to learn right now. So thanks so much.
Yeah, I hope to be back. We've, like I said, Joseph presented, hours and hours worth of wonderful content in certain areas. So, if you have me, there's so many fun things that we can all teach each other. And I think that's good for your audience, Jack.
Absolutely. I think we could do this conversation for 5 hours. We will have to leave it there. Randy, you are at the Bond Freak on Twitter. Joseph, of course, as everyone knows, you are at FedGuy12. Thank you so much. And thank you everyone for watching.
Thanks, guys. It was wonderful.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined. Check out today's sponsor, public.com, at public.com/forwardguidance. That's public.com/forwardguidance. Also, you can get 10% off to Permissionless 2023 and Blockworks Research using code GUIDANCE10. Thanks again, and be well.